Stop scrolling right now, because what I'm about to tell you is one of those moments that people only understand after it's already too late. This is not hype, this is not fear-mongering, and this is definitely not normal market behavior. For the first time in more than 30 years, central banks around the world are holding more gold in their reserves than U.S. Treasury debt. Read that again slowly, because this is the kind of information that quietly changes everything. Not more dollars, not more U.S. bonds, more gold. That single shift tells you more about the future of money than 1,000 headlines ever could. For over 5 decades, the U.S. dollar has been the backbone of the global financial system, trusted by governments, banks, and institutions across the world. Countries held dollars in treasuries because they believed the system was stable, predictable, and safe. But belief is not permanent, and trust can be lost much faster than it is built. The United States has been printing money at an unprecedented pace, while debt and deficits continue to grow without any realistic plan to stop them. Every new dollar created reduces the value of the dollars that already exist, and the world has been watching this happen in real time. Foreign governments are not emotional investors, they are strategic, and they act long before problems become obvious to the public. They saw U.S. debt explode from trillions to tens of trillions, and they understood exactly where this road leads. So instead of waiting for a crisis, they prepared for one. China increased its gold reserves. Russia increased its gold reserves. India, Turkey, Saudi Arabia, and many others did the same. And now gold has officially overtaken U.S. treasuries as the preferred reserve asset. This isn't politics or ideology, this is pure risk management at the highest level. Because the dollar wasn't just weakened, it was weaponized. When Russia's reserves were frozen, every country learned a painful but important lesson. If your reserves are held in someone else's currency, they are not truly under your control. Gold does not depend on trust, permission, or political alignment. That is why central banks are choosing it now, quietly but aggressively. And when central banks move, private capital always follows. And when gold moves, silver never stays behind for long. Silver is not just a monetary metal, it is a critical industrial resource used in solar panels, electric vehicles, electronics, and advanced technology. Demand for silver is rising sharply, while supply has been struggling to keep up for years. This has created a structural deficit that most people don't even realize exists, only to suddenly crash overnight while most of the world was asleep. That move wasn't natural, and it wasn't driven by fundamentals. It happened in illiquid trading hours for a reason. Major banks are deeply short silver through paper contracts that represent metal they do not physically possess. As silver prices rise, those paper positions turn into massive losses that threaten balance sheets. We're not talking about small numbers, we're talking about losses that can reach into the hundreds of billions. So the banks did what trapped institutions always do when pressure builds. They smashed the paper price, triggered stop losses, and shook weak hands out of the market. This was never about ending the rally, it was about buying time. And here's the key detail most people missed. While the paper price dropped, physical market signals exploded in the opposite direction. Silver lease rates spiked to extreme levels, meaning people were willing to pay almost any cost just to access real metal. That is the physical market screaming that supply is tight and getting tighter. At the same time, Shanghai, the most important physical silver market in the world, slashed position limits. Exchanges only do that when they are worried about delivery pressure. In simple terms, too many people are asking for real silver, and there isn't enough to satisfy them all. This is what stress looks like before a system breaks. Some experienced investors have taken partial profits, not because they are bearish, but because they understand risk management. They are rotating from physical silver into silver mining stocks to increase leverage on future price moves. That is not an exit, that is a calculated escalation. And then there is the math that almost no one wants to seriously discuss. If currencies ever need to be re-anchored to reality, even partially, gold prices don't rise gradually, they reset violently. That is why silver moves faster, harder, and more explosively during monetary stress. Levels like $90 or $100 are not the destination. They are pressure points. At higher prices, paper manipulation stops working, and physical demand takes control. This moment is not about speculation, it is about structure. Central banks choosing gold, physical silver shortages, rising lease rates, exchanges tightening rules. All of these signals are pointing in the same direction. When trust in systems erodes, hard assets win. The biggest mistake people make is waiting for confirmation, because confirmation only comes after the opportunity is gone. By the time it feels obvious, inventory disappears and prices have already moved. The real opportunity always appears when things feel confusing, manipulated, and uncomfortable. That is exactly where we are right now. The noise is loud, the dips feel scary, and emotions are being tested on purpose. This is not the moment to panic. This is the moment to understand what is actually happening beneath the surface. Because when paper promises fail, only what is real matters. And that shift is no longer coming. It has already begun.